Good morning and welcome to this SuperReturn webinar. I'm Adam West at SuperReturn, and today I'm joined with Rajindar Singh, Sub-Regional Director, APAC Fund Services at TMF Group, Gong, Partner at Pantheon Ventures, and Eric Marchand, Principal Private Equity at Unigestion. Welcome. We will also be live tweeting this webinar today, and you can join in the conversation by using the hashtag SRWebinar. So before we jump into the discussion, I'd like to remind you that we'll be holding an interactive Q&A at the end of the session. So if you have any questions during the presentation, you can send them in using the Ask a Question box on the left-hand side. So now I'd just like to hand over to Rajindar to get started. Take it away, Rajindar.
Thank you, Adam, very much. Yes, basically the topic of this webinar is raising funds in an era of digitalization. What do LPs and GPs really think? So I have lined up a few questions for Eric and Jay, and they will give their insight, deep insight, practical, pragmatic insights, and then at the end of this round, then we would go to the Q&A and then finally wrap it up. So basically, I will start off with the first question, which I have. What does digitalization mean for different sectors? We understand digital transformation is changing business models and the ways firms compete and offers potential to yield substantial consumer benefits. So in your view, what do we understand by digitalization? So perhaps I can start off this with Jay first.
Great. Thank you, Rajindar. Well, digitalization is an extremely broad subject, and it transforms industries in a myriad of ways. As you said, it empowers distribution channels, it adds means to deliver a service, it shortens supply chain, making it more transparent. It also leads to more targeted marketing and solicitation of more effective feedback from the customers. For the incumbents, it also creates new competitors that has a technologist makeup in its heart. So very hard to summarize in a nutshell what digitalization means. I think it has different manifestations in different industries, which we can all talk about.
So perhaps, Eric, you can give your views on this?
Yeah, I mean, I think largely I agree. It goes well beyond just simply the tech industry. The tech industry percolates throughout all the different sectors by providing, digital solutions to, improving a number of processes, across the globe, across industries, but I think the side note of this is that the digitalization and technology should, I think, be perceived more as a facilitator of process in a way of, not necessarily always replacing human interaction, but really by kind of developing a more efficient way of doing things, and actually in a certain sense should be embraced. But I would like probably to add the fact that there are pitfalls to this digital era. I think there's a preconceived concept of people thinking that by embracing this digital era and really embracing tech in your processes and your companies will solve everything. And I think the technology and the digital improvement that you can bring to your company are only as good as the processes that you've developed. And I think I'd take one example is, having people outside your office. The digital era enables people to work outside of their office, from home, and from, anywhere they are. But if you look at examples like Yahoo, that when Marissa Mayer took over the company, within 6 to 9 months, they'd stopped the home office policy, but they realized that, yes, people were using tech to work outside the office, but their evaluation processes and surveillance processes of of their employees had failed them, and they were realizing that people were actually not delivering on the deliverables. And
I
so
thanks,
I think it's really
Eric.
a balance of
I think this brings us to the next question we shall like to pose. What is the impact of digital revolution on more traditional markets such as real estate, financial services, and healthcare? I mean, generally in the market itself, some could be more advanced, some could embrace the technology much faster and so on, but there are also traditional players as well and so on. So I think it all depends what is the impact. It might be quite progressive impact, or it could be calibrated in a very different way for different audience and so on. So Eric, I think I'll start off first with you on this one.
So basically, healthcare, the simple fact that it has medical imaging, etc., it has really embraced technology and digitalization quite quickly. I mean, 15 years ago, we were talking about already electronic medical records, sharing of a patient's background. This was in the mid-2000s. So really, healthcare has seen that progress. When you look at financial services and real estate, I think these have been more resistant to change. However, if you're looking at a lot of the thematics around today in the PropTech and FinTech space, you're seeing a number of new, kind of disruptive technologies, disruptive, companies that are trying to attack the financial services industry, for instance. So I think that those sectors are kind of the next frontier of embracing technology change and changing the paradigm in typically archaic sectors.
Thanks, Eric. Jay, what about your insights on this?
Sure. I think the several industries you mentioned all have been quite heavily impacted by digitalization. So take FinTech, for example. There have been quite a lot of progress in the mobile payment, in the instant money transfer, in the instant loans, and even in robo-asset management. So the financial services industries have been both incubating those FinTech applications and be the biggest customers or adopter of them, but there are also many startups that have made waves in each of those sectors. So it's a very, I would say, fast-moving space to watch. And overall, it increases the accessibility of financial services to customers. And likewise, in healthcare, both the existing players and the new players have benefited quite significantly from digitalization. The prevalence of, I would say, telemedicine today to enable people not living in city centers to access doctors, to access better machine learning enabled diagnosis is one case in point. And there are also other advances that are frankly unthinkable several years ago, such as the 3D bioprinting of organs and tissues. It's a medical reality today, as well as the greater computing power enabling the genome sequencing to be accompanied diagnosis for targeted therapy or personalized medicine. So that's another area of great advancement. So I think healthcare is right now seeing a lot of the fruits borne by digitalization, and that trend is going to continue quite strongly.
How do you view, I mean, basically you have e-commerce coming in very strongly in the market. It has impacted, in fact, the real estate investments as well, and then also having an impact on the supply chain management, on the logistics, on the shipping side, and so on. So, what's in your experience? Would this continue further and so on the e-commerce side? There will be more investments. Eric, perhaps you can give your insight. Yes, Jay, go ahead, please.
Okay. So, Rajindar, I think e-commerce is certainly right now a very powerful distribution channel for goods. And we are seeing development of omni-channel distribution model by manufacturers to make sure that they're capturing customers both through brick and mortar stores as well as online channels. And that there are also many innovative forms of e-commerce through social network and other means to really adding to the user stickiness. So I think e-commerce is certainly here to stay, and it already captures a very large portion of the market share when you look at the overall retail volume. On the real estate side, I think China is probably a good example of how digitalization really assists with the brokering of real estate deals. China doesn't have a system like in the US, multiple listing system where there's generating deals, listed properties, and there's verifiable sources. So that leaves scope for company to actually create a generating database and using the database also to better track the origination of customers and also the sources of housing to allow brokers to collaborate with each other rather than competing with each other. So that lends itself quite well for, I would say, digital-enabled services. I echo Eric's comment earlier. You know, the digitalization is really a enabling layer of an existing business in traditional industries like real estate. So it's not a technology company per se, but really a company with already a strong existing offline capability to develop a powerful layer to make its productivity more efficient and to scale more quickly.
Thanks, Jay. Eric, do you want to add something on it?
Sure. I mean, the answer was already quite comprehensive, but I will add to it for definitely. I mean, e-commerce remains a growth area and will do so for a while. I think the main issue here is from a competitive standpoint. So if you consider companies like Uber, Grab, which are the shared economy, but it's kind of an e-commerce business industry. There is fierce competition, and to this day, we're not seeing these companies actually generating profits. And if you look at the share price at Uber, it's been taking a beating since its IPO. So I think there is a constant growth in the sector. It will continue to be a promising one. However, I think there needs to be a bit more focus on how to make these companies profitable. And sometimes it's unfortunately at the expense of the people that are delivering the service and or product, meaning that you're going to squeeze your drivers if you Uber, or you're going to squeeze your motorcyclists when you're at Grab Food, and then that is leading to a pauperization of the employees, and you're actually competing with more traditional businesses at a lower cost of labor because you found regulatory shortcuts to maybe not pay someone minimum wage, for instance. And I would be cautious on this market at some stage where if local authorities start looking at this with greater scrutiny, and they have, and particularly in European countries, that it might really kind of change the paradigm for these companies where you're by squeezing the person or they call the auto entrepreneur, you might not be as profitable from a business model perspective. So yes, it's a growing industry. It's really pervasive across the globe. The consumers are much more likely to buy stuff online than they used to be. The newer generations are much happier in buying things online, and they're fine with it. versus the quote unquote older generation. So that is really the secular trend driving all this. But ultimately, it comes down to when the going gets tough, are you actually generating a profit? And that bears a pretty massive question.
Thanks, Eric. All right. In light of the digitalization of different industries, how do GPs now innovate and package their offerings to LPs? Is there a shift in portfolio allocation to certain sectors? Basically, I mean, how do fund managers, in light of the new technology and so on, compared to traditional ways, how do we actually kind of innovate and position yourself in the market itself in the face of LPs? Perhaps, Jay, I can start off with you on this.
So in the GP land, there are venture capital companies that focus on early stage businesses, and many of those, if not most of those, have a pretty heavy innovation element. Those companies tend to have digitalization as a core part of their strategy. So that's VC has been doing this for many years, and that there are also the PE businesses that target traditional industries or traditional companies. And these days, digitalization permeates many aspects of traditional industries, and in many cases transform them, leading to new business models. So to be fluent in the subject of digitalization is a must-have skill for the GPs. We don't actually see shifting per se of allocation because I think each GP has its strengths. It tends to have a particular space it's good at, and where it has differentiated resource or domain knowledge. So there's no point in shifting of strategy to do something just because something is new, emerging, or is rising. But rather, we are seeing GPs building up their in-house capability to help their portfolio companies get upgraded on digitalization capability, and also equip themselves with better tools to use big data analytics in their due diligence. So to answer your question, not so much of a shift of allocation or shift of strategy, but more to think, okay, how can digitalization serve my interest, and how can my portfolio companies be protected from the disruptive forces of digitalization?
Thanks, Jay. Eric, over to you now on your insights.
No, I mean, I think in terms of asset allocation, I think most people perceive tech as a defensive sector. From a buyout perspective, I mean, when you're looking at the tech industry and with profitable companies that you can buy out, funds like Silver Lake do these massive buyouts. They're benefiting seemingly from underlying growth more than being linked to where the global GDP is behaving. But I think on the other non-tech sectors, I think what digital transformation has become central to most investment strategies, and a little bit to what was referred to before, a lot of your general partners will kind of try to build, in addition to an operations team, a specific knowledge and team that can roll out digital strategies for most of the portfolio companies, because these themes are becoming crucial to keeping a competitive edge in any given sector. And I think that is also started percolating as well into the GP's own operations, where, as mentioned before, they're trying to use big data to do better due diligence, to analyze maybe their sourcing efforts better, et cetera, et cetera. But also, I think, to maybe be offering their investors more transparent data, more immediate data. And all of this is very necessary because these are the basic questions that, LPs will be asking when you're fundraising. So therefore, I think if GPs today haven't embraced internally digitalization and externally within their portfolio companies, I think it would spell trouble in the future when it comes to actually addressing these issues and these questions when they're fundraising.
Thanks, Eric. How do LPs and GPs navigate the high valuations and competition that is rife in technology investments? There will be a lot of investments costs involved in embracing the technology and so on, and naturally this would result in higher valuations for the portfolio companies and so on. So how do LPs and GPs navigate this new environment? Jay, you can give your insights.
Okay, thank you. I think the high valuation is fairly concentrated in the late-stage venture space, in particular those nearing unicorn status and those that have already reached it. So in that segment of the market, the valuation is heavily correlated with the public market sentiment towards the technology sector, and the valuation is at a very, very high level when you think about the many stages of the company, which many of them are not yet break even, and some of them still have their business model somewhat in flux or the competitive position not yet established. So we have always had a bias towards early stage venture, which we think is very defensive from a valuation point of view. If you navigate to the right players who are disciplined and have expertise in the areas they target. And I think on the other hand, technology really helps companies that PE investors committed to lower cost, to boost productivity. So it really is a very powerful enabling tool. It actually brings down the cost of scale and increases margin if applied appropriately. So I think that the valuation concern for me primarily reside in the late stage venture segment where there are many names that are crowded trade, so to speak, given their popularity and their high visibility in the market.
Thanks, Jay. Eric, you want to add on something?
I'll take a slightly different approach on this question, in the sense where I'll focus on valuations in the tech industry, but more from a buyout perspective with companies that are already profitable. I think I wholeheartedly agree with everything that's been said on the venture side, and it's true. The late stage venture is very dependent on a market mood, whereas if you come in at an earlier stage, you're a bit more protected from the craziness of valuations in a sense. But if you look at the more established tech companies and or even mid-market companies that are growing, there's two things you need to be comfortable with when you're looking at these companies. Is one, that the secular trends of digitalization behind these companies are really supporting the revenue growth and make them, again, quote unquote, defensive, as mentioned in the previous question. But two, it's more important to understand as well, it's the relative market competition and understanding, if there are risks of new entrants in the given digital market that you might be, a first mover in, because that will also determine the sustainability of your margins. So typically, what defines a tech business is that it's growing quite quite nicely and rapidly, but also it's a very, very high margin businesses. But suddenly, if you can see there's a multiplication of players in that a said niche or a said industry, you will be facing market competition, and therefore you will probably most likely see your margins decrease. So therefore, that would not justify a high price anymore. So it's really making sure that you're paying a high price for a high, a cash generative and high growth company. Otherwise, your value breaks somewhere.
Thanks, Eric. Yes. All right. The next question would be when looking at technology investments, how do LPs view sector focus versus the generalist funds? Would they have an appetite more for the sector focus, or for the so-called the generalist funds which we have been having traditionally and so on? So can start off with Jay first.
Yeah, that's a difficult one to judge. I would say that technology investments tend to be invested by, technology-oriented or technology-focused PE and VCs. So in that case, there's already a given focus baked into the mandate of the business or of the investment. So we also see generalist funds making investments that are technology in nature. I think it very much is dependent on the in-house resources and expertise developed by the GP in a particular area, whether it's social media or whether it's life science. And it's difficult to judge on the basis of whether it's a generalist fund versus a sector-focused fund, other than saying that domain expertise is extremely important, and the GP's ability to dig deep into a space and have a demonstrable track record of success in a particular sector is very important.
Thanks, Jay. Eric, over to you.
Well, quite simply, again, we're going to have probably a very similar view on this. I will say, though, that generally having a specialty in any given sector will give you an edge from a sourcing perspective, because if you have the smart entrepreneurs that can gain comfort on the fact that they're selling either a minority of their company and or giving you control of their company to partner with you, and that you have a sector knowledge and a track record of delivering on that knowledge, it will definitely give you, the upper hand when negotiating for a deal. But I'm more of on the cynical side of things. You can be a sector specialist, have the best experience in the world, but if you're pricing the deal 20% lower than the competitor, I would completely understand that the entrepreneur will probably not consider your sector specialty as really additive to the whole deal, and probably would go for a generalist. But I also would like to add the fact that there are some very talented people in generalist funds, and it just so happens that generalist funds naturally navigate towards sectors in which they're comfortable, and you will always see some very, very competent sector specialists within generalist firms. So I wouldn't necessarily want to be dogmatic about it. I will say that, yes, sector funds kind of give it an edge, but it can be compensated within generalist funds if the individuals have the right set of experiences to back their sector knowledge.
Thanks, Eric. Do you think the LPs expect more returns for the risks involved in the technology, because technologies are pretty fast-paced and so on? They get absolute with the new technology being introduced with new innovations. would they kind of attach any higher returns for the risk of being obsolete and so on? Perhaps Eric?
I mean, if we refer back to the example of venture in China, yes, obviously, I think what you're looking at when you're doing early stage investing or venture investing in China is that there is an inherent risk in what you're doing. These companies are sometimes competing for funds, for markets, for consumers. So therefore, you know, a bit like what was mentioned before, some people like to come in at an earlier stage to mitigate that risk, to get the valuations they want and maybe come out at some stage. It would be great to, you know, kind of look at it as in we're investing in a company, it's growing, and let's get out. But there's a risk for being that. Do I want a 2x out of my investment? No. I'm going to aim for, you know, 3, 4, 5x. So obviously there's an inherent hope that on the on the tech side you will get higher returns, but I think it's more of a numbers game, and blended you want to be, you know, you want to navigate between 2 and 3x because you're never going to get it 100% right.
Thanks, Eric. Jay, are your views consistent with Eric, or you have something alternative?
Yeah, I'll add that the expected return is really dependent on the stage of the investment. Much of the technology investment happen in the venture stage, where a company's business model is still evolving, company hasn't generated profit, and sometimes have not generated revenue. So commensurating with that risk, there is a higher level of return expected. But having said that, there are also technology businesses that have already turned profit for a number of years. There are many SaaS companies that are already very profitable, have demonstrated great cash flow, recurring revenue pattern, and so forth. And they would, the investment on those will have a relatively lower return than the venture businesses. So I think it's less a statement on technology per se than really which part of the life cycle the business is on, and how stable it's and how long the track record is for the business.
All right, thanks, Jay. All right, I mean, basically, you might be, you know, kind of deploying digital tools in your so-called your environment, on your GP environment, to kind of enhance the analytics and help investors better monitor their investment, basically when you're doing the investor reporting on a quarterly basis and so on. What kind of digital tools do you really invest in, and then how are they being utilized? Eric, any views on this?
Sure. I mean, we've gone through internally an entire exercise of revamping our digital tools. I think what we wanted to be able to do was to not only provide a really user-friendly, investor-friendly interface for our investors, where they can kind of dig in themselves into a portal and not get like these just paper reports from us, or PDF reports, obviously, but where they can kind of slice and dice data and look at how, you know, the performance of their funds, the performance of specific companies, and really having a drilling tool with that accompanied their investment with us. However, this also had to come with a lot of work on the data integrity side, where, you know, I think we realized that we weren't probably capturing all the information from RGPs and their subsequent portfolio companies, and we really needed to do a whole data cleanup exercise. So I think that will come as a second comment, is I think when you're thinking about building these digital tools, it all comes down to process, but also it comes down, in our case, to data. So if you don't have the right processes to capture the right data that's relevant for your investors and maybe relevant for you, in the longer term, then, you can choose any service provider, any technology provider you want. But if you don't have these things in place, it matters little, how good that solution is for you, because you haven't done your homework and the groundwork before implementing these solutions. So again, it comes back to the earlier conversation of, digital is great, tech is great, but if your processes are rubbish, it's not going to help.
Thanks, Eric. Jay, what about your views on this?
Yeah, I think I'll add the GP perspective on this. We're seeing increasing number of GPs having some in-house experts or personnel to do digitalization for portfolio companies. Those tend to have the background from one of the larger internet giants, and they are a operating partner that really try to address the pain points of portfolio companies in developing online capability and other sort of digital capabilities. We also see that GPs increasingly use data or big data to vet their due diligence outcome, or to serve as an additional leg for their commercial due diligence. I read some staggering number recently on Forbes. Over 90% of the data in existence today was created in the last 2 years. That just goes to show what proliferation data is and the speed at which it's created. And so for a large-scale market like China, you can imagine the volume of customer data available to be analyzed for patterns to be collected from such analytics. So I think that's a very powerful tool, not to replace human insight and judgment, but as a complementary window into behavior, or to enhance underwriting and to add to the confidence of pricing on deals. That's very handy. Another area is post-investment value add, whether it's to make the best site selection for new openings, or whether it's to optimizing merchandise display in a retail setting. I think big data can help inform decisions in many ways.
Thanks, Jay. Just as a matter of interest, in your team itself, now you have more technology intensive opportunities and so on. Was there a change in the in the lineup for your investment team when they really go into the market to scan or scout for opportunities and so on, compared to the traditional days when you have where the technology is not so advanced and so on? Now you're getting more innovative itself, more advanced. Do you actually look out for higher skilled, experienced investment professionals and so on? Eric, perhaps you can join.
Yeah. We actually have a dedicated team that is looking at innovation. So the profiles that we've been recruiting are not only your stereotypical investors, but we have a partnership with an engineering school in Switzerland where we have an internship program, and we are utilizing their knowledge and understanding to try to apply, tech and digital to the way we invest. So I would very simply say that it's a very topical theme for us at the moment.
Thanks, Eric. Jay, do you have something to add?
I think there are two elements. One is that we're seeing, particularly at the GP level, more hiring from people from a background in the internet industry or technology industry, those that have the relevant degrees and, more importantly, the relevant experience. And secondly, the younger generation, the millennials, they grew up in the digital environment, and they're naturally more fluent in the digital products, and they have a much higher level of intuition towards digitalization in all its forms. So by making sure that there are young talents on the investment team able to have a more, I think, a technical understanding of the application of digitalization is also very important in really rounding out the experience and judgment of the older generation that have seen how the scene has evolved, but may not have as much hands-on experience with the digitalization outputs.
Thanks, Jay. I have these two questions from the audience. I think I'll put forward to both of you. First question, basically, how does digitalization affect the fundraising process itself? I would assume that are the challenges the same? How do you actually convince your LPs and so on? Any delays in their decision-making process before they put forward their commitment subscriptions? I can start off with Eric first.
To be honest, it affects the fundraising process very little, in a sense where it is still relatively archaic, the way you reach out to your client base. I think what we're trying to do is to become smarter about it, being able to build tools to provide data, above and beyond your stereotypical data rooms, which is the obvious, digital change from a fundraising perspective to make everything available. But I think what we're trying to do here is to simplify these processes, provide a much more tailored and better service to our clients, and improving the communication, and maybe also capturing what our clients want in a more personalized manner. But I think this is still, if I'm very, very blunt and honest, at its infancy. It remains a very person-to-person business. But I think above and beyond that characterization, there should be ways where technology can actually improve those interactions and improve the efficiency of our sales team. From a GP perspective versus us, I think it's very similar. I don't see, necessarily a massive change. Yes, there are some platforms that offer you to fundraise and get, you can put your preferences on and you look for them, etc. But more often than not, these platforms are populated by funds that are not necessarily ones that we would invest in. So it still remains quite old school, quote unquote, if I'm blunt. We still have the use of placement agents. I think they're far being replaced, because the placement agent is not only someone who's trying to raise capital for you, it should be someone who advises you, a kind of a consultant, a marketing consultant for your fund. So there's aspects of that where technology will always struggle to replace that. But look, it's changing slowly, and I think there is ways to disrupt this sector. But overall, fundraising remains a very person-related business.
Thanks, Eric. Jay, do you want to add something on this?
For us, I think digitalization is mostly applied in the collection, maintaining, and the monitoring of the data. We have a very large pool of portfolio companies through our GPs, and to make sure that the data can be accurately collected and reported to all LPs digitalization plays an integral role in that process. We also have added a digital tool to allow us to better monitor the ESG incidences of our portfolio companies to really make it a very strong or seamless coverage of any development on that area, which is very near to and dear to our heart. So again, technology is able to assist in that area as well.
All right, thanks, Jay. Would the fund life cycle be shortened because technology is getting so advanced and so on? Would it remain at the same 8 years life cycle with +1 extension to 10 years, or do you think going forward the fund life cycle might be reduced? Eric, you might want to give your views.
I don't necessarily think so, because it is a function of the quality of your portfolio. So I don't see necessarily a link between the digitalization and the fund life cycle. I will say, however, that it might reduce your fundraising life cycle. If you look at items like, and I'm not very knowledgeable in that space, but it seems to me that technologies like blockchain might reduce the time of fund formation, of legal negotiations, reduce the prices of all these processes, while still requiring people to carry them out, but really simplifying them and making them maybe in a sense much more secure and fair. However, again, the fund life cycle, I don't see tech markedly improving it, because inherently, if your businesses, you can't exit them, your fund is going to stay open. I'd be curious to see a dissonant view on this.
Thanks, Eric. You brought up a good point, fund formation. Do you think in any way how the GP structure the funds and how they actually set it up going forward, would that have be affected by this digitalization and so on?
Yeah, short answer is yes.
All right. How do you see it? Would it go through the traditional limited partnership formation, or do you think something else, they would actually go through a much shorter route of structuring?
It's unclear at this stage, but however, there are some people attempting to find digital ways of running transactions, of gathering capital, of exchanging, for instance, secondaries on a more digital way, of securitizing in a digital way, your fund partnerships. I wouldn't say there's a definite, norm that's coming out, but there's a number of attempts to make, I would say our relatively archaic industry more digital. Do I exactly know under what final form it will take? Unfortunately, I'd be very, very rich if I knew.
Thanks, Eric, very much. Jade, do you want to add something?
In the foreseeable future, the use of digital tools is really to speed up efficiency in the storage of information, exchange of information, and to really help with due diligence, to help with quantitative analysis. I don't see this replacing the role of a broker, because private equity is a human business. So there's always going to be a need of relationship, a need of human discretion, and digitalization, while very powerful as a tool of assistance, it's not going to be a wholesale replacement of the people involved.
Thanks, Jay. There is a question which basically from the audience, do you work with placement agents, and what do you think about their role in fundraising? Perhaps Jay, you can give your views on this.
I think placement agent has been playing a very important role in being the bridge between the GPs and LPs, and they are quite instrumental in helping those GPs that are either emerging or relatively new to the fundraising process to open doors, to get themselves prepared and coached to be roadshow ready, so to speak, as well as to taking on often arduous tasks of producing PPM and other documents. So that role hasn't diminished. For the more mature GPs, they tend to develop their in-house IR teams and rely less on the placement agent assistance. But certainly for the newer GPs, we see the role of placement agent to stay.
All right, thanks, Jay. Eric, do you want to add something?
Not much. I think simply that they have a crucial role. Their role is to really cover the market, know every single GP in a given geography, and I'll be honest, I find them extremely useful to my everyday work. But I think what's interesting as well is the fact that whether you're looking at a less mature, more mature GP, which most probably does not outsource its investor relations or fundraising processes because it makes it more efficient. The interesting bit is frankly that they keep on a pulse on the market, and that's something that's very, very valuable for GPs, because unlike our position where we see a number of GPs, I think a given GP might have a very, very narrow view of what's happening, and speaking to placement agents and understanding a little bit what is going on in the psyche of the market, and particularly LPs, is a useful piece of information that I think sometimes GPs should focus more on. And that's where fundraisers come into play. It's not only about just the numbers. It's not a numbers game here. It's really it's an optimization game of reducing your time to market, because the least time you spend fundraising, the more time you spend investing and monitoring your portfolio and fundamentally creating value at the end.
Thanks, Eric. All right, just one final question from the audience itself. Financial services related companies, are they investable as compared to companies selling FMCG products in retail and online? Eric, you want to try this?
I'll try. I mean, they are investable. I think you have some retail financial services businesses, and you have some non-retail financial services businesses. So I think the two worlds can be somewhat interlinked, and I think it's on a case-by-case basis. Any company is investable. It depends on what profile of deal you're looking for, and what level of risk you're willing to take. Maybe some people think that financial services will be less impacted by GDP growth, but maybe there's some more contractual revenues there versus an FMCG. But really, it honestly depends on a case-by-case basis, in my personal, humble view.
Thanks, Eric. It has been very insightful from Eric and Jay on this, given very good constructive views, leveraging very well on the experience in the fundraising market. So without further hesitation, I will hand over to Adam to wrap it up. Thank you very much.
Thanks, Rajindar, and thanks, Jia and Eric, for your time today. But that's all we do have time for. So thanks for joining us today. And please do complete our short survey at the end of this webinar to let us know your thoughts on today's discussion or any recommendations for future webinars. It should flash up on your screen shortly. You will receive an email with a link to the recording of this webinar in the next few days and an exclusive 10% discount for SuperReturn Asia taking place on September 23rd through to September 26, 2019 in Hong Kong. And thanks everyone for your time today, and thanks again for our speakers.